There we go. Okay, all right, we are set to go. All right, welcome everyone. Welcome to the KoreSummit webinar series 2021. Once again, my name is Oscar Joffrey. We're gonna have a fun time. We're obviously changing the times as everybody's starting to notice. We're gonna try something new. We're gonna try things a little bit later now. We're gonna be going to a 12:30 p.m. schedule and 4:30 p.m. schedule to see if this helps people schedule to be able to make it. Thanks for the feedback that we've been hearing from everyone. And the format is still the same. Today we have two great speakers. One you haven't met before, maybe you've seen Marty before in other webinars. We're gonna have a great discussion that, as always, no PowerPoint presentations. This is just dialogue so you can hear what's actually happening from those right at the front lines of things. And if you want to see this, it is on YouTube live as we speak. It's also available on KoreSummit.io. And once again, everyone, thank you for your support in our initiative to make sure that we educate as many people as we can. So I am, you can tell I'm really excited about this. I've been waiting for a long time for this discussion because it's just gonna be fun. But before we get into it, let's get with the introductions. Jesse, you're new to the, please take a moment to introduce yourself.
Sure. My name is Jesse Stein. I'm the co-head of real estate at Republic. Some background on Republic. It's one of the leading crowdfunding platforms in the US, formed in 2016. We have over 1 million members. Me and my team were brought on last year to build out the real estate business line. So as you can guess, the answer to the question of can real estate use RegCF? I would answer yes. There's certainly some challenges that we'll be discussing over the next hour.
Perfect, thank you. Marty, I know you, but maybe those out there don't.
Yeah. Marty Tate. I'm with I'm a securities lawyer with the boutique law firm Carmen Lenhoff Israelson in Salt Lake City. Been active in crowdfunding since the very beginning. In fact, even prior Jobs Act, I was trying to figure out how to do crowdfunding for some online lenders. So, and have been active in the space. I represent a number of platforms, lots of issuers, service providers. I said I've known Oscar since the beginning. So yeah, just happy to be part of this call and this talk about this subject. I think it's exciting.
It is. It's really exciting for me. I mean, look, I get excited about a lot of this stuff. I think it's great that every single time we keep, I don't want to keep saying moving the needle forward, other than we're doing just what we said. We want to include everybody and include everything that in the past was not available to them. And real estate, I mean, this is real. I mean, this is the real McCoy. It's been really the average person out there, 233 million Americans, never get access to it other than they have to buy their home and that's it. But now they can actually invest alongside, the other players. And so this is going to get an exciting conversation. So Jesse, we're going to start with you. I mean, first, let's discuss the differences between, obviously you mentioned some challenges from a real estate. Let's talk about what kind of transactions you've seen that is working versus not working. So we'll start from there, and then obviously Marty will move into more on the legalities of it. But let's start with you because you're actually doing it.
Yeah, and I think when you discuss the various challenges of the industry, you have to look at it from both sides, both the investor side as well as the sponsor side. And crowdfunding in general is really creating a marketplace that builds an equilibrium between those two types of investors and sponsors. On the investor side, there's a little bit different type of value that's provided for real estate than there is in, say, raising capital for startup companies, where the innovation on investing in real estate online is really at that property specific level. You see on all these platforms, people talk about the democratization of real estate. The democratization of real estate has been around for decades, since the modern REIT era began in the early 90s. Everyone has had access to real estate, but it's been in a form of a big portfolio, diversified by geography, often diversified by asset class. So the real innovation with real estate crowdfunding is the ability for an investor to invest in a specific property. And investors typically look for a few different things in deciding what type of assets they want to invest in. It could be a location. Is it close to where I live? Is it a location I'm familiar with? Is it somewhere I vacationed? Is it somewhere I would love to vacation? Did I read an article about that city and I would love to get exposure to that city? Real estate, location, location, location. The same thing applies in crowdfunding. And being able to provide targeted exposure to a specific location, whether it's block by block or city by city, is a real innovative aspect of real estate crowdfunding. Second, you're able to offer certain types of assets that aren't available in the public market. And it could be new type of operating strategies like co-living or ghost kitchens, or glamping, right? There's a lot of interesting innovation within the real estate operating space where sponsors now have a vehicle to go and raise that capital. And then, of course, there's the sponsor, right? At the end of the day, crowdfunding is based on building a network of investors, a network of followers. And, this really provides an ability for sponsors to go out to networks that they have built over time and bring in capital in relatively small dollar amounts.
And that's interesting. It's good that you broke it down to you democratized the real estate property itself. That's really interesting, because when people think of real estate right away, they're thinking buildings and all that. You cornered it down to a very specific kind of, I don't want to say asset class, because real estate is the asset class, but the component of it. And Marty, I'm going to come back to you. I mean, I personally have not seen any. So for me, I'm an educator. I'm going to be asking questions like any other investor. How does this happen? How is this different than your traditional guess? Where investors investing in this whole package. How is this going to be different structure for an investor and in the RegCF model?
Well, let me back up just a little bit. People have been investing, doing crowdfunding with real estate for since the passage of the Jobs Act and the regulations that came out. In fact, that's probably been the leading asset class from the beginning. Not probably, it has been. And the most successful, at least the earliest success in crowdfunding was in real estate. And the reason for that is real estate's it's an asset, like Jesse was saying, that people understand, right? You can look at a building, you can look at a house, you can look at whatever it might be and say, oh, that makes sense. A lot of the platforms came out and did, some of my clients, they came out and did debt, right? So they were offering a note that was secured by an asset that you could participate in. They did these payment dependent notes and so forth. So people were able to invest have been investing in these assets, and there's been tremendous success. The difference between that and what we're talking about now is all of those were done under 506C. So they were limited to accredited investors. So as a non-accredited investor, if you wanted to invest in real estate, like you said, you had, your only option was to, invest through a mutual fund or some sort of publicly offered vehicle, a REIT or something like that. And there's been a lot of, and that was sort of the interim step. You had Fundrise and Realty Mobile and others offering these, their REITs, and so people could come in under a Reg A plus offering and invest in those. But again, you're buying into a package of real estate. And so RegCF, I think that the biggest thing is with the changes, and we'll talk about that because that's really what's kind of pouring gas on this, is the ability for non-accredited investors to invest in real estate using RegCF, and for issuers to raise capital into their projects using RegCF. I think there's, the friction between the two is being eliminated, or at least minimized.
Well, that is an interesting point. I mean, Jesse and the team, you guys had, I mean, what you pulled off with $1 million, it's pretty good. Now, March the 15th. So based on what you've already indicated, what you've been doing, will the asset, well, I don't want to say that again, but will the type of real estate change because now you can do 5 million, right? I mean, that's got to be able to bring in, and I am going to walk into the investor part soon as well, because I think this is a wake-up call, everyone. I mean, in my view, those who were privileged got it, and everybody else kind of sat back and couldn't do anything. You're changing that. So let's start with the increase. How is that going to change potentially the type of real estate that you put in front of people to invest in?
It's tremendous, and ever since those rule changes have been announced, the responses that we've gotten from sponsors, it's been a complete 180. Where, in most cases, $1 million is not a lot of money for real estate, right? And when you're talking to a sponsor and you start saying you can raise up to $1 million doing this, sponsors that are successful, that are working on larger projects, that's not very interesting to them. Now that you have that $5 million limit, all of a sudden it's a decent sized equity chunk for most projects. So I think you'll start to see more experienced sponsors start using RegCF. I think RegCF will replace Reg A in a way where, you have had very few real estate sponsors who have successfully raised 5 million from non-accredited investors through Reg A, right? You have the Fundrisers, you have the Realty Moguls of the world. They have huge marketing budgets that most sponsors, do not have and are not going to be able to put to work for a Reg A offering. The fact that you can raise capital privately through, 506C while you're doing a Reg CF doesn't necessarily limit the amount of total capital you'll be able to raise through crowdfunding. And in a way, it makes it a lot easier for people to raise larger amounts of capital from the entire crowd, accredited, non-accredited.
Did you get disconnected there, or is it just me? We're good?
Yeah, can you still hear me?
Okay, good. Oh, yeah. No, I can hear you. So let me ask you this, Jesse, before I go into Marty. So obviously the sponsor is going to be happy. So the way you're balancing is saying that with the Reg CF, you're going to be able to do the Reg D rather than opting in for the Reg A. I do agree. In the past, the Reg A's, we didn't see that. I think now with the 75 million, it's kind of changed that. But I want to keep this discussion really on the Reg CF, because I do feel that in real estate there's $100 million deals, 50, 10, and there are a lot of good deals, multi-unit homes at $5 million. It's most people get left out of it. So is the idea that you're looking for companies to be doing the combo, or is it just purely going to be more from a Reg CF point of view?
No, it's we work with companies using all of the exemptions, right? CF, A, D. The point I was trying to make is that in general, you'll see sponsors who are working on larger transactions use CF. And CF, regardless of the size of transaction, can be used as a complement to a more traditional capital raise for sponsors who already have a capital base that they typically go out to. It's a way to build that network. And, the smart sponsors that we speak to, they realize crowdfunding is still in its very early stage, right? There's been tremendous growth over the last 5 years or so, But while today a crowdfunding raise might just be a complement in raising for a larger project, over time, we all know it's going to continue to grow. And we're going to get to the point where sponsors are going to be able to raise as much capital as they need for a project using crowdfunding. Whether that happens in 2 years, 5 years, 10 years, we think the industry is going to get there. And investors, they like reinvesting with the same sponsor that they're comfortable with. So, sponsors are starting out today looking to build a network, an investor base that they can go back to over time. And each subsequent offering or each subsequent project that they do, they have that base to begin with. And they know, like in building a social media following, you have to start somewhere. And the larger you can grow that base, the more volume you can bring in on your next capital raise.
And I know you keep referring to sponsors, and this is a brand new dialogue that we hadn't seen before. Marty, how does that fit in? I mean, so when you're used to going to a platform and you invest in the company directly, now we're hearing the word sponsor. What is a sponsor? Right?
I'm just using the term sponsor is the management of the real estate company. Okay. So, it's different than say an operating company where you have your CEO, COO, whatever, your management team. The sponsor is basically the management team that you're investing in. But one other point regarding the raise and limits and the size of these offerings. What's different about real estate and operating companies is you don't have these various stages. There's no C, there's no A, there's no B. Real estate exists, and there are different types of projects. It could be development projects, or it could just be a buy and hold. But you're typically not getting in early as compared to the person that's investing, a few years down the road. You're maybe getting in at a different value or a different time within a project. But what that means is a small project can generate just as good of returns as a large project. And, that's where we've seen a lot of success in CF, where, a project might need a limited amount of capital. It doesn't necessarily work for a larger institution or even a high net worth, but allowing the crowd to make relatively small investments to aggregate that small amount of capital that's needed to do the project is just a very, very good method for a company to raise the money for that project.
Okay. So as I said, it took us a few years to get everybody equipped to online investing. Marty, you and I have been through this a long time. Does this mean that obviously the new rules allow the accredited investor? Will the accredited investor prefer to do it this way rather than the traditional way because that's the one investor that already knows it? Or will the non-accredited investor, because they need to get adjusted. Like as I'm taking notes here, I'm hearing the word sponsor, the word projects. It's not a return, it's a timeline. Like, do you know what I mean? It took us a long time to teach the current crowd, which I have no problems with it, but which is established already on the accredited. Just want to hear your thoughts on.
Yeah, well, accredited investors have been investing in real estate through crowdfunding for years now, and I think that's something they're very comfortable with. And I don't think it's going to be a big hurdle for non-accredited investors to start investing. Like I said before, it's one of the advantages of real estate is it's an easy asset to understand. A lot of times, like Jesse was saying, it might be something local. They might be able to say, oh yeah, I know that building, or I know that area, or I've been to that city, or whatever it is, so they can, people can understand. So I think from an investor standpoint, I don't think it's going to be a big hurdle to get people there. I think they're going to be able to invest, and one of the other things that Jesse alluded to is that, real estate, unlike an operating company, they're designed to have returns. A lot of times you're investing in a company into an asset that's going to be producing revenue. You're going to be investing in it might be an apartment building that's being rented, or a retail center that's being leased out. But in addition to that, there's usually an exit event that happens, that can happen. There's a market for these exits that might be different than an operating company. You invest in an operating company, and you kind of hope that it will get sold. You hope that it will go public or something, that there'll be an exit. But with real estate, there's almost always an exit that's built in. So that's something that's comes into play.
Yeah, so that's interesting. So on real estate, what distinctive difference is there's going to be that dividend. So now this is very new, right? We haven't seen that before. Nobody right now, they get a digital certificate of ownership. Now these holders are going to be receiving. So Jesse, how often is that happening? Is that something that is done on a quarterly basis, annualized basis, or are you holding that earnout until the property goes out? What kind of structures are you doing?
It varies, anywhere from monthly to annually, but it is one of the major differences, between crowdfunding for real estate and crowdfunding for companies, where, it's a hurdle for a sponsor to have to deal with making distributions to potentially thousands of investors, providing tax documents to all of those investors, where within an operating company, whether you're raising capital through a SAFE or either through a priced round, like you said, until that company potentially exits, right? That's a long shot to begin with. You don't have to really worry about that. You provide them updates, you provide them with communication, but there's really no, financial back and forth the way there is with real estate in projects where we're paying dividends. The flip side to that is, by being able to pay dividends, there's a bit more transparency as far as how your investment's doing, right? Hey, we estimated we would have 6% returns, and our dividends are 6% as well. So, everything is on pace. The value of our asset is in line with, where it was previously. So it gives a little bit more comfort and security to an investor than, what a startup may. But that's, all part of the investment strategy, right? You're investing in a startup to hope you hit a home run and get 100x on one or two of them. Where in real estate, you're not looking for that moonshot type return. You're looking for more steady returns, both in the form of income and also appreciation.
And that, you brought up an interesting element here, that is where the traditional real estate with a sponsor and all that, and dealing with a credit, the number of a credit and the size of check they write, their check is significant. The number of people they deal with is smaller. And regulation CF, that changes it all together, the number, the size, and hence the reason for the distribution components. Do you think that is going to, because distributions are, under RegCF can only be done by certain parties, depending if the companies fall under a certain rule, with Rule 12G. So how is that being done today? How are you handling that distribution? Because typically that distribution would have to go through a TA, and the TA distributing and tax documents, right? So I'm just curious from that perspective.
I mean, that's it. You need a transfer agent, right? Like Core, to provide that service, and it's a very valuable and it's something that's required, because almost no one is set up to do that work themselves. The distributions, the tax, it's just extremely time consuming.
And that could that be the barrier? But if it's all brought to you by Republic, that's what your intent is. Here's the package, here's the turnkey component, doom, right?
Yeah, it has to be a service that is set up in advance of a company running a campaign. And if you think about it, a lot of these campaigns, they're $100 minimum investment, where even a 5% annual dividend return, you're talking about making a $5 dividend, and that's on an annual basis. If you're doing it quarterly, that's $1.25 that you're sending, per quarter. You get to the point where sending the money costs more than the actual dividend amount. So it's a challenge, and I think service providers in general within the industry are going to figure it out, and make it as efficient as it can be. But it's more of a sponsor, saying, hey, do I really need to deal with 1,000 investors, right? And you want to be able to say, no, don't worry about it. We have processes in place where you don't. Each time you want to make a distribution, you make a single payment to the transfer agent. They'll deal with 1,000 investors.
Yeah, no, I agree. All these questions that are going through my head are they're critical. So, Marty, I got one for you that I guess, I understand the difference between an operating company and obviously real estate. So how does this get packaged up in an instrument that obviously where the safe has been that, or the note, and because it's clearly not going to be an instrument of equity, because if it's 4,000 holders, what kind of instrument are we looking at in order to put real estate in?
Well, and I'd love to get Jesse's input on this, because they're thinking about this and doing this, in real life. But one of the things that we haven't talked about yet, and one of the biggest changes, and we actually did a little webinar on this a couple weeks ago, maybe, was just the use of an SPV, and that change to the rules, to Regulation CF. I think that is a huge benefit, because now you can have these investors come in through an SPV, and these SPVs will be set up as limited liability companies. You'll just be buying interest, and people will have just a percentage interest in that entity. So rather than subscribing to a SAFE, you're just subscribing to membership interest in the LLC, that will then turn around and invest in the project, right? So I think that's a huge win for the real estate. I mean, that was, for me, that was one of the biggest obstacles, is how do you get the equity, or get the investment into the project itself, especially by use of a sponsor. We've heard these terms, capital stack, of you've got an equity piece and debt and different types of things, and sometimes the sponsor has capital in as well. And it just became really difficult to crowdfund that, because you had to invest into the operating company. And now you can come into an SPV. That SPV can then fill out a portion of the capital stack. Some of these I presume will be all equity deals, but I would guess that most of them, that crowdfunded piece is going to just be a small portion of the total capital that's going into this project. So it might be a $20 million project, and they're crowdfunding $4 million or $5 million to cover that that equity piece that's needed by the sponsor in order to get the debt. So
it isn't, Marty, I've been talking a lot about the SPV. Sorry, you froze there. Sorry, Marty.
So anyway, that to me, that's the way that, oh, sorry. Hopefully I'm back. To me, that's the way that, that's the way they'll invest, is just through subscribing to that LLC.
So, okay. So that, I was going to bring the SPV ticket in, because the last webinar you and I did, we had a great discussion. There's still a lot of ambiguity. Maybe for Jesse, it isn't, because, so maybe I'm going to ask you this. I don't mean to put you on the spot, Jesse, but so what instrument were you using before the new amendment? And then, of course, going forward, does the SPV bring you any comfort that there is one? I mean, I've been working with a number of fund administrators to bring an SPV package. And they go, yeah, 1 million, yeah, we'll do it, 5 million. And then they ask how many holders. And that's when they say, no, no, no. So, I've approached one of the 3 most prominent names out there, and they like it. They go, no, you got to get the numbers down. I go, well, no, I mean, Jesse wants to get people to put in $100. And so they want in, and I found a firm that can actually do K1s and all that fully automated. So it's gonna. You're right, Jesse. The interesting thing is the solution is there. So I can tell you unequivocally, the solution is there. The key is, are the right participants in each of the buckets willing to work together? I'm going to work with this firm because I want to do anything I can. Now I need a fund administrator. So, but let's answer the first question, then move into the second part.
Sure. So, I mean, as far as the securities that have been issued for our offerings to date, for the most part, they've been typical LLC membership interests, where investors are coming into the company directly as members. And, we do have a system set up right now that does create an intermediary entity to aggregate investors, and then, results in, a single investor on the cap table of a company. There are some inefficiencies there. The new rules that, are going to be put into place with respect to SPVs, helps form a solution, like you said. But, there are a number of different moving pieces where it's certainly doable. And there are certainly firms that are capable of creating these products to make it seamless for a sponsor and seamless for an investor, where, both realize the benefits of having this intermediary entity. So it's going to happen. It's going to happen, this year for sure. And we'll be able to offer both. We'll be able to offer, an investor the ability to invest directly with a sponsor and become a member directly into their LLC or their limited partnership, however it's structured. Or, from a sponsor's perspective, a lot of them, don't want that. They're very happy to have the SPV as an investor and to let the SPV or Republic deal with all those underlying investors.
Interesting. And from that point, that brought up the other discussion we had, Marty, was, okay, so we got the SPV. Who is the management of the SPV? Who is the proxy component to it? This is the part that you indicated there was no guidance yet from the SEC, but we didn't have the guidance 2015 when SafeSquare went out. So it basically is going to take a player like what Jesse's doing to start creating an instrument to then put it in front of the SEC and say, this is the way we see an SPV rolling out. Am I getting it correctly this time? I mean, we've gone through a few. You're on mute there, buddy. It's okay. Marty's
there we go. Sorry. So I think so. And I think that Jesse's, aptly said that I think these, the platforms are going to be either themselves or working with third-party providers to provide that, management and administration of those SPVs, because that's, in and of itself is going to be a nightmare, like you, or potentially could be a nightmare like you referenced. So I think that's one of the things that, like everything, we figure out how to become more efficient and develop. But I like I said, I think that's the 5 million is a big change, but the SPV to me is the one that I was really lobbying for. So I'm glad to see it, especially I think in real estate, it's going to be a game changer for sure.
Well, I believe it's the instrument that most accredited investors are most accustomed to. So, and now under RegCF, they can invest with no limit. So that changes it. So do you think that's going to help you, Jesse, the fact that, before you have restrictions, now the regulators have given you a gift. So the SPV, just so you might have missed our previous webinar, one of the areas that we're struggling with, Jesse, is that not only finding a fund administrator and all those pieces, which will come because that's service providers, but it's the legal structure of the SPV, because the intent of by the SEC is that the SPV sits right underneath the company. This is not put it over there and I'm not responsible for them. In fact, it's very clear. You're still responsible for those holders. It's just they've given you this idea to put this one entity on your cap table. So the key here that we haven't fleshed out yet, and this is where maybe you and Marty should have a conversation, because Marty's really eager to get on the road on this one, is the how do you structure the actual legality of the SPV as to, from the traditional model to being the proxy vote for the SPV. Do you know what I mean? Have you guys put thought on that yet? Or, so it's kind of two-part question. Now you get accredited, they're accustomed to it, so they're going to be looking for it in both models. And then, of course, from the structuring side.
Yeah, I know that. Well, we have a solution in place today, prior to the SPV rules being implemented, that basically does a lot of the same thing, and that's using an omnibus custodial account, where it is aggregating investors. Investors are technically giving up some of their rights, but it does create, a lot of the same benefits. When implementing the SPV, I'm not 100% familiar with the SEC's guidance on the new rules with respect to SPV. I know that our counsel has suggested that there are some limitations or some issues with how they've described the new rules that don't make it as effective as it can be. So it's not my area of expertise. I think it will certainly get worked out at some point this year. I do think it will be the go-to structure for the majority of offerings, unless a sponsor for some reason wants to interact directly with their investors. But it's like you said, it's an administrative thing. A service provider is going to figure it out. The SEC, I think, has good intentions as far as putting that into place, as far as creating efficiencies. So we're going to stay on top of it and make sure we implement the best structure possible. Okay,
so like everything else, if we were going back to 2015, I think everybody was applying the same rule of thumb. Obviously, the market is moving in such a rapid pace right now. I think this time we're going to get to an answer a lot quicker. Before, we figured that it was going to take time. I think there's enough information now that we can actively pursue this very, very quickly with people that have been there, done that. I know you got Max on your team. You guys have done great work at Republic, innovating the instruments that companies can use, and then of course investors can invest in. So and again, I'm so pumped about this, because quite often there are many projects that, and I'm using your term, of course, I usually use the word company, but projects that are only looking for that 1 to 5 million. and they're very, they're going to be comfortable with that, which is fantastic. But I think they're going to need to know that whole turnkey, because if not, that whole thing just slides downward, where they need to start peeling things together to make it work, which is really not what any of us want at this time. So I guess the next question that I'm going to get to, so the one thing that you've mentioned a lot, and I'm going to concentrate a little bit on this, because for the respect of the audience, whether it is the non-accredited investor who, like me, you put the term out there, the term inside out, like all of us, we use terms like RegCF, Reg. So what the heck does that mean, right? So can explain to me, so I understood you saying the sponsor is the management of the real estate, and you're investing in the sponsor, meaning the management. So what more are you doing? Or is it any more? Is there a different Form C to be filed with the SEC because it is real estate? And then 2, are you doing any additional due diligence on this? Because it is a very, like, how do you know they actually have that block, right? Sorry, Jesse, and then I'll go back to you, Marty. My apologies.
Yeah. Sure. I'll touch on the first question, then answer the second. Marty can answer the Form C question in more detail. It's the same process as far as, Form C is required, reviewed or audited financials are required. The information in the Form C, I would say, is 75% the same. The risk factors in general are slightly different. The discussion about the business is more of a discussion about the property's history, projections, plan of operations. But it's not too far off from a Form C that you would see for a company, and the process as far as onboarding is very similar as well. As far as due diligence, there are a couple different layers of due diligence, right? It's verifying some of the property information that the sponsor has presented. It's evaluating financial projections, historical financials, making sure that those line up, making sure the terms of the offering are at market, right? We don't want, sponsors to think that, crowdfunding investors are the dumb money and to offer terms that are completely outside of what's typical in the real estate market. And then it's reviewing the sponsor and making both an objective and a subjective evaluation as far as the competency of that sponsor, reviewing their track record and determining if it's someone that we want to work with and someone that we would want to invest with.
So Marty, to you, I heard a lot of different things here, and I'm going to come back, but I want to hear about the Form C from your end.
Yeah, so I think Jesse nailed it. It's the document obviously is the same. There's going to be differences that, like you said, the risk factors are going to be different. This description of the business you want to go into. I look at it like if you're doing a private placement for a operating company versus doing a PPM for a real estate deal. Obviously, with the real estate, you're describing the project. You're describing the the asset and it's going to be a little bit different that way. But again, you still have to follow the requirements of Form C. They didn't, the SEC hasn't issued any particular guidance or different instructions with regards to the SEC or with regards to the Form C. So it's still the same form. It's just there are going to be differences. One of the things that Jesse hit upon too is that, in a real estate deal, I guess if you're just, typically when you're doing something like this, if the sponsor already owns the asset, that's one thing. But if they're going in and they're acquiring the asset, you also have to coordinate all of this in connection with the real estate closing, escrow agents, and so forth. So there are some other differences as well. I mean, this is like a real estate closing is different than just, hey, we've raised the money and now we can take it and start doing whatever with it. Here the money's going to a specific purpose and you've got to have everything lined up at one time, I would imagine. So
Marty, I'm glad you brought that up because that is one of the biggest challenges with real estate offerings is, for the most part, sponsors need money when they're buying a property. And the way it works is you have limited time in order to buy that property. A seller isn't going to give you 6 months, 12 months, to come up with the money. Not that it takes that long to raise capital for via crowdfunding, but it's very difficult to manage that timing as far as getting a campaign live, raising the capital, and then closing on that capital and ensuring that that capital is ready to close on an acquisition. So it's just really hard to use crowdfunding as a way to fund an acquisition. I think that's something that will change over time, right? Eventually, you'll be able to get a campaign up and raise capital and have it in a week. Just today,
I like that. A week. Come on.
Yeah, but
I know.
I think it's true. I mean, you've seen that.
The case.
Yeah.
The way I see that is if right from the original transaction between the two parties for the real estate here, it's on some sort of blockchain that comes down over here to do the capital raising. It's all inside. You're right. I from a technology point of view, we're all there.
Well, and one of the things, Oscar, I mean, you kind of joked about that, but one of the other changes that we haven't mentioned is just the ability to test the waters. I mean, in RegCF, we've been limited. Basically, you can't say anything about it until you're live with the SEC. Yeah. Whereas now, people can go out, and as sponsors putting everything together, they can start getting indications of interest. And so that hopefully that period where they say, okay, we're a go, we can shorten that and meet those deadlines. Because like Jesse said, you put a property under contract, you have a certain time period that you've got to bring your financing together. You've got to get, debt, equity, all of that together. So there's a crunch, but hopefully these rules will help make that easier.
So I don't think it's a strange question, but so I get the Form C, it's the same as everything else, but you are doing more due diligence than just, because the expectation from issuers is, hey, I filed my Form C, the SEC's got it, which typically some platforms have that philosophy that, we'll get you ready. You're obviously having to do more work than that. You can't just take it on just based on the Form C, correct?
Yeah, no, there's a lot of, supplemental information or backup information that we're collecting, to verify the information that within the Form C. It's another way that real estate is different than an operating company. A lot of times when you're evaluating an operating company, you're looking at the management team and you're making this fully subjective decision. Are these people that I feel are going to be successful? Is this a business model I'm going to be successful? There's less tangible aspects for you to actually diligence, right? You're betting on the future of a business, and that's really just, you're guessing, right? Based on, whatever intelligence that you can gather in asking questions and looking at, whether it's historical, but you're still betting on a vision. In real estate, you're really, looking at a tangible asset with a lot more information that can be verified. And, in looking at assumptions, it's much easier to say, hey, that doesn't make sense. You're not going to be able to sell this at a 3% cap rate in 10 years, right? Or that's not, a market-based assumption. Where in an operating company, you can say, yeah, we're going to grow revenues by 50% a year for the next 10 years. No one knows whether that's correct or way off base. But in real estate, we can evaluate the assumptions that a sponsor uses in, valuing the property today and valuing the property in the future, and, what returns each of those are going to generate, and make sure they're, make sense and that they're marketable.
Thank you for that.
The other thing is just, and I've done a lot of real estate stuff over the years, and in connection with this, and I'm sure Jesse's team, you've got to look at, title reports, and you've got to look. Anytime you're doing real estate, there's, you've got to review the purchase contract. There's a lot of other. There might be environmental reports. So there's a lot of other complicating factors that go into that diligence. So, and I'm sure that's stuff that you guys are all thinking about and doing. So.
And that's what I was trying to get at. It's very different. I mean, if I come in with my software, I show you the software, we show you the document. Real estate, you got to know. So here I'm going to throw one at you, Marty, first, and then obviously I'd like to hear your comment. So I'm a US-based company, but my real estate properties are in Thailand, Indonesia, Canada, Australia. Is that going to change it, or does it have to be in the US? This is does the property need to be physically in the US? Marty? For RegCF only.
So Jesse might correct me on this, but I don't think so. I mean, as long as, the rules require that the issuer be a U.S. company, and if the issuer is an SPV that's, organized for investing in this, I don't think so. Jesse, do you have any thoughts on that?
No, I agree. Okay. We have an offering for an international property that's live right now on our platform, and they set up a U.S. entity to own the real estate, which made it eligible for RegCF.
So that's the key. So the eligibility is making sure as you said, the sponsors, the management is in the United States, where the properties may be. So that's an eye opener for everybody else listening in, that here is a way that you could have a project of $5 million. Because in other countries, $5 million, you can do a lot. You can build a lot of homes. And this has been, guys, this has really opened my eyes a lot. Seriously. I mean, I got a ton of other questions. I think the one question, but it sounds to me, Jesse, that you guys have really found a way around it with your LLC membership element. But as this picks up, it'll be interesting to see what the SEC's point of view is. Are they going to be saying, listen, we want everything on this SPV, but with that clarity not 100% there. But once it gets there, I just think it's going to be, do you think this could become the number one sector within RegCF in the next 2-3 years? I mean, what are your thoughts on that, Marty? I mean, we've done a lot of work in other sectors, but
yeah, I think it. I don't know. I just know that real estate has been the big. I mean, that's by far dominated the crowdfunding industry. So I don't see why it wouldn't continue to have a strong position. I think RegCF for companies, operating companies, is going to continue to grow, but I don't see why it wouldn't continue to dominate this field.
And Jesse, well, it's kind of self-serving, but
Yes.
yes, of course, but don't tell Max, okay? Don't tell the rest of the team, because
no, that's one of the reasons why we were so excited to join Republic, where we did think that there was this niche available in the marketplace to offer interests in individual properties to both accredited and non-accredited investors, right? You do have a bunch of platforms that are selling property investments to accredited. You have, the non-accredited platforms that are selling non-traded REITs to both. But, there is, certainly an interest from all investors in investing in specific properties. The great thing about real estate is you have just such a huge amount of potential product that's available, right? And especially when you're talking about doing smaller deals like fix and flips or single family homes or individual condominiums, right? You almost have an unlimited amount of supply on that side, whereas the same doesn't exist for viable operating companies. So I think the question is going to be, how much demand can be generated from the investor side, to match up with that potential supply on the property side. Like I said earlier, I think we're still at the very, very early stages. Someone made an analogy to what's happening in Bitcoin right now, where you're now starting to see major institutions, major investors, finally get involved after years of saying, it's not for me, it's just a fad. And something similar, can occur in crowdfunding, where you've had early adopters, right, going back the last 5 years since Jobs Act was put into place, and you are starting to see more institutional type sponsors beginning to use it. Everyone wants to be able to raise capital from retail investors, right? It might not necessarily be through crowdfunding, but when you see the Blackstones of the world raising billions and billions of dollars from retail customers, some of who are investing as low as $5,000, every other private equity company looks at that and says, hey, I want to raise retail capital. And we've been speaking to major asset management firms that want to raise capital from retail investors, right? Whether they use RegCF or Reg A or even Reg D with a smaller investment amount, it's certainly of interest to the industry as a whole. And I think the potential is tremendous.
Yeah, it's interesting when you were describing it, the flippers and all that. You're right. When you start adding all that up, it all fits under that whole real estate umbrella. So it never even dawned on me. I just keep thinking, commercial building or residential building, but we're not just talking about that. It's basically the A to Z. You are right. I mean, look, real estate. I don't remember if you remember this, Marty, in Orlando, we had the first session of crowdfunding association. I'm going to bring you back a few years, 9 years for all of us, but we were applauding that $50,000 was raised in equity crowdfunding. Do you remember when Rodrigo went on stage and he said, "I'm doing 300 million in real estate," and people's jaw dropped to the ground? And we're like,
yes, I do remember
how did that happen, right? And I remember, Jesse, I don't know if you ever saw this, but this in the early days of the Jobs Act, everybody thought it was going to be early stage startups and all that, but it ended up being real estate. It was real estate that glued it there. The realty moguls, the real invest. There was a lot, and not everybody survived. I got it, but there were some really good, legitimate companies that are still there. I really believe that this is going to be impactful all the way through. The key will be not now that we've democratized it, but we need to streamline it. One thing about real estate that I do know is that from a front end, you can streamline, great, but you got to get that whole back end process completely streamlined because of the distribution, of the tax one returns, and the ongoing reporting. And to Marty's point, hey, before you even take on this project, there's this whole administrative element that needs to pass through as well to give the security assurance to the investor. So this is I like this one a lot more because it forces a lot of companies to work together for the greater good. Nobody can stand alone. You obviously started it, and this is I'm applauding it because I think it's going to do well for the industry. Let me ask you one final question to each of you, if you're able to do so. I know, Marty, you and I have seen a lot of portals, and I know you're still helping new ones. If they were, let's say, like a Republic, and I'm not picking on Republic, and they're doing traditional software companies and all that, and they put real estate in there, how do you think that's going to fit in? Or do you think it's going to need to be put in a different category on its own? Because to Jesse's point, it's got a different differentiation. You don't want to kill the other ones. You still want them to get their capital while this one's offering a dividend. That's right.
Yeah,
so what are your thoughts on that?
That's a business decision, I guess, for somebody like Republic, to decide whether they want to do that. I don't see why not. I mean, they've had great success, and I think the world of that platform. And I wouldn't be surprised if you see other groups entering that field. I represent a lot of sort of the smaller and specialized platforms that do different types of. So I have, for example, represent some 506c platforms and RegCF platforms that do real estate, particularly in sort of specialized assets like farming. And we've had discussions about this. I think you'll see some of those platforms actually evolve to, and go through the process to become licensed to do RegCF, because I think, I think you'll see an expansion that way as well. I think you'll see the people that were doing operating companies expand into real estate, and the real estate people expand and do RegCF. So I think, the market will just get bigger.
I like to hear that. Jesse, what are your thoughts? I mean, I know you came into the Republic family. You obviously embraced it. How do you feel about your asset class being alongside of it, or do you think it needs to be properly positioned out in the same brand, Republic, but in a different area? What are your thoughts on that?
I mean, Republic has made a real effort this year and is continuing to make an effort to expand the assets on the platform above and beyond early stage startups, right? So in addition to real estate, they bought a video game company that sells interest in video game development. There's a big crypto business at Republic. They bought another CF platform that's more focused on Main Street type investing. And the way that, and having a platform that allows an investor to invest across different asset classes, we think gives us a big advantage in the industry, because you don't necessarily need to go, to different platforms to get different types of exposure. And we do separate it on our platform, right? But we also allow someone to look at everything all at once. Your portfolio is blended. Ultimately, there'll be pie charts that show you own, X percent of your portfolio in startups and Y percent in real estate. But, I think where the industry is heading, and people have been calling for, consolidation for a long time, but multi-asset platforms where, investors right now might have 10 different accounts, one for their cars, one for their baseball cards, one for their art, one for their startups, one for their real estate, right? And, we think ultimately, you'll be able to have one account and be able to access all of those different investment types.
I like that. I like that. It's a great way for all three of us to close off today. Jesse, I'm glad you were able to make it. Marty, I'm always enjoying our conversations. I hope, as you can see, I am so pumped right now how it's evolving. I really am. This real estate in RegCF, I knew about you, Jesse, before. I've been following you because one of our clients we sent over to you. And I'm glad, I think it did work out for you. It was a Chinese company that we had, and it does sound like it did. And I'm a big advocate of democratization without the ultimately making sure that we're keeping everybody safe. Because look, we only got, I think we said it before, 358,000 investors in RegCF last year. This year we've got to get over that. I mean, it's close to the million and not more. To be actively investing and just scratching the surface of it. And I believe real estate could really bring more light to it, because people I know real estate, I get it. And the fact they get into that, they'll maybe look at, to your point, Jesse, look at that. I would have never looked at that company selling juju juice. I think I like that. I think it's going to be very interesting. So thank you both so much for making the time in a bit of short notice this time. I do apologize for that. We are changing our schedule. For everybody else, the videos will be on KoreSummit.io, and of course, KoreConnect's YouTube channel. There'll be all the speakers' information if you want to get a hold of Jesse, and of course, Marty. Their information is on KoreSummit.io website. You can reach out to them directly, or we'll provide it to you. Thank you both. Have a fantastic week. Jesse, wishing you all the best for 2021. I mean it. And Marty, you and I will be talking very soon. I think that SPV thing, we got to get nailed down.